Good morning. It's a bit cold, but it's fresh. So a lot of questions about RAPID and what it stands for, and I was hoping just to put a bit more information about this. RAPID stands for Regulatory Alliance for Progressing Infrastructure Development. It's an alliance between Ofwat, the Environment Agency, and several water bodies. RAPID was created because the normal planning process wasn't getting the infrastructure through fast enough. So this process shortcuts the development and speeds up the delivery of the large infrastructure. In short, RAPID exists to make big infrastructure happen, even though it may be controversial or financially not viable. So how does RAPID work? Well, a water company proposes a strategic development. They say it's really important and vital to the country, so therefore it becomes strategic, and they say it has to be on a super scale, which makes it less easy for people to object to it. And of course there's this NIMBYism that's thrown into it. Oh, not my backyard, you know. What is it? Is it because of that? Or is it because we'll actually be worse off for it as customers? How does RAPID work? Well, it's 4 gates. Gate 1 is the idea worth looking into. And let's pass that already, because yes, arguably we need the water. Gate 2, we narrow down the options from viable alternatives. So we rule out things like Severn water transfer. But of course that was ruled out 2 years ago based on the fact that this reservoir was supposed to cost £2.2 billion. Now it's up there 7.5 billion. Certainly brings back into the Severn water transfer option. Gate 3, we prepare for planning consent. So this is where we're at the moment. So SESRO has already passed the first 2 gates, which means that it's passed the proposal in principle. But remember, so did HS2. And how did that work out? Seem to remember that at some point we decided that it was just too expensive. Anyway, look over there, right in the distance, you can see some deer. 2 or 3 deer just tracking across. So HS2 wasn't too much of a success on the financial point of view. We've now got a huge scar going along the whole of the country. And yes, ultimately it'll work out, but you know, did it get us to Manchester and beyond? No, it didn't. So now we're at gate 2. Who's been paying for this? Well, you have, as customers. You and I have been paying for this on our water bills, and will continue to pay for it. So this is already being paid for by us. That's why your water bill has gone up so much this year, just to cover some of these costs. Even if SESRO was cancelled today, hundreds of millions of pounds have already been spent and sunk into this project. So of course that makes it harder, doesn't it, for everybody to try and say maybe we shouldn't do this, because now they've already sunk the money in. And the RAPID process also favours these sort of huge projects. It doesn't really favour the alternatives. So when you start to finance things or calculate the finances, the huge reservoir is the one that always comes out more favourable because of the way that the framework is. So even if the alternatives are cheaper or faster to deliver, they don't fit the framework that's in place. So it's just fighting against itself all of the time. So where does the responsibility sit? Well, it's with Ofwat, it's with DEFRA, and it sits with the RAPID board. You know, those people have already poured money in. So does Thames Water stick SESRO on their books? No, they'll probably create a special purpose vehicle for it, an SPV, and they'll bundle the debt underneath that. So effectively the build out will happen, the debt gets transferred to the SPV, and that's set up as a separate organisation. So the debt sits with the SPV, Thames Water get the payments, gets them out of the situation they're in. The government doesn't end up with debt on their books, and the customer ultimately pays off that huge debt. Don't forget, to the tune of somewhere between £8,000 and £10,000 over the lifetime of it. So, you know, everyone's bill goes up by £100 to £150 in today's money. Of course, that'll increase by at least 2% inflation until it becomes somewhere like £8,000 to £10,000 over 40, 50 years. So, yes, the government's going to deliver something significant, tick the boxes where they can say we're delivering huge infrastructure. It ticks the box from a financial point of view, so the investors get their money. It's safe because effectively it's financed in such a way that there's no risk, and the customer gets to pay, and all for something that actually hasn't been clarified that it's actually required. And the fact there are alternatives that would be quicker to deliver, cost less, and have significantly less impact on the environment. So the SPV, let's say that's called SESRO Infrastructure Limited, just for an example. This special purpose vehicle is set up to carry the can for the finance. The SPV would own the reservoir. It would borrow the money, it would receive the regulated payments that come in. And more importantly, it'd be isolated from the significant debt that Thames Water is in. So, okay, so where does the funding come from? Well, According to various sources, it comes from pension funds, insurance companies, infrastructure debt funds, and possibly sovereign wealth as well. And of course, there'll be our overseas friends who will be investing heavily into these sort of debt projects, or these projects where they can leverage the debt and pass the cost on to the customer. And who guarantees the repayment of that debt? Well, you, the customer. You're going to guarantee it by paying your bills every month for the next 60 odd years. And of course, the allowed revenues are set to cover the debt and the operating cost and the investor returns. So all of that has to be covered from you, the customer, who will be paying dearly for it. So what happens if, for example, Thames Water enters administration, it gets broken up, it's partially nationalised. SESRO still avoids that because the SPV is separate. So we know that the costs have gone from 2.2 billion to 7.5 billion. Where's that come from? Is that come from the government coffers? No, it's not coming from them. It's private financing. But it's private long-term financing, which is going to cost more than if the government was to finance it. And ultimately, it's going to cost more to the customer to pay that finance back. So who's investing in this sort of project? Well, probably pension funds. They need sort of long-term inflation-linked returns. They're happy with low risk, slow but guaranteed income. And they like assets that last somewhere in the region of 50 to 100 years. So perfect for them. And why is the SESRO a perfect fit? Well, bills will rise with inflation, so you're safeguarding yourself from inflation. Water demand is non-optional. Clearly, it's a commodity that's required, and the regulation protects the revenues. So it's even built in that the inflation will happen plus some. So pension funds don't care if the reservoir is unpopular. They care that Ofwat guarantees their repayment. Who else is interested? Well, insurance companies, because again, they hold huge pools of capital that must be invested safely. They need predictable cash flows to match the insurance liabilities. So they love these sort of projects. So the bottom line is that SESRO will be financed by pension funds, insurance capital, infrastructure debt funds, infrastructure equity funds, possibly even sovereign linked capital. All of this ultimately paid for by the customer. So the question is there an alternative? And the answer to that would be looking north towards Scotland, where Scottish Water has a publicly financed proposition. If this was a government borrowing, the costs would be lower, there'd be no dividend extraction and no refinancing games. The customer still pays, but obviously with lower bills. There's no shareholder returns, there's lower interest rates and no profit margin built in. But it's not popular because the debt then sits on the government's books. So how does that work? Well, a publicly owned company builds and owns the reservoir. It operates independently and its borrowing is backed by government but operates separately. And the key advantage to that is that the borrowing costs are close to government rates. There's long-term planning without investor pressure, and the regulator focuses on service and not on returns. Let's start getting some quality water running through some pipes without leaking. That might be a good start. So is it realistic? Well, yeah, it is. The government creates a publicly owned SPV just for SESRO. It's financed by a gilts or public infrastructure bank, and it sells water wholesale to regional utilities. This is a similar model to Scottish Water. And it's pretty powerful because it removes the biggest asset from Thames Water's financial chaos. Let's face it, we don't want to be putting some of this into the hands of Thames Water, who are 20 billion in debt anyway. It prevents the private extraction. It keeps waters as operators, not asset owners. So looking at the Scottish Water model, why aren't they pushing for mega reservoirs? Well, there's a simple answer. There's no need for return on capital. The pressure's not there. Unlike in the private SPV that's in place for Thames Water. So it's a done deal, right? Well, no, not quite. I mean, there is this pre-DCO consultation going on until the middle of January. And how could this be scaled down or stopped altogether? Well, Ofwat sets the allowed revenues and ensures the financeability of the project. If Ofwat concludes that SESRO is overpriced, if it's unnecessary or poorly justified, which we know it is, because from gate 2 years ago, we've gone from 2.2 billion to 7.5 billion. So who is doing the maths on this? I don't know. The project could be financially unviable, which we know it is. And, there's evidence that has happened before with HS2, where clearly it was unviable. And this project in itself just isn't viable on the scale. There's no need for this to be the scale that it is. The only reason that this reservoir is the scale it is purely for financial reasons. And you, the customer, are paying for it. And there's a lot of people saying, look, can we just throw this out? And that isn't necessarily what everybody is saying. What some people are saying is, can we just take another look at this? Because the finances don't seem to make sense. The government could insist on re-looking at the application. They could request a revised water resources management plan, and they could shift support towards alternative solutions. The Secretary of State for Environment, Minister, has the power to do this. They have the option to say, can we just have a look at these numbers again, because it didn't work out too well previously in other projects, so maybe we should have a quick look at this one. And ultimately this comes down to strong leadership. It's going to take somebody to stand up and say, we might have got this wrong, we need to take another look. And in the political environment we're in right now, it may actually be quite beneficial to some political parties to start championing that idea. Let's have another look at this. Let's consider what's right for the people and not necessarily what's right for the finances. For huge amounts of debt to be financed for people outside of the UK potentially to make a lot of money. And just to make it clear, that risk of those increased bills doesn't sit with the people locally here, local to the reservoir. This sits with 15 million people across south of England. So by the way, this isn't NIMBYism, it's going to get you too. You're going to go end up with your bills going up by £100 to £150 a year, and you're going to pay somewhere in the region of £8,000 to £10,000 in the lifetime of the project. So 15 million people are going to be impacted by the extra cost here. And that's based on today's costs. That's just based on the 7.5 billion. That's not based on the fact that this will probably double. So alternatives could be considerably cheaper. Perhaps saving tens of pounds per household per year if we were looking at things like seven water transfer, leakage reduction, and reducing the finance costs. So there you have it. There's my assessment of RAPID. It's a framework that's put in place to accelerate projects of this scale into privately financed projects. It means that you, the customer, will ultimately pay the cost of this project. It takes the project off the books from a Thames Water point of view. It takes the risk away from the government, and ultimately the risk sits with the customer and the cost sits with them too. And rather frustratingly, there is an alternative. It's a public SPV that could finance something like this, and the scale could be backed down because we don't need the scale to justify the investment and therefore the returns. So yes, if there is an actual need for this reservoir, which is beyond perhaps the 7 water transfer pipe, the reduced leakage and the better usage of water by customers, if we still need a reservoir at that time, it doesn't need to be half the size that's being proposed today, because it'll financially wash its own face. If you set this up through a government SPV, it can be financed differently. The overall cost to the customer will be lower and the overall risk will be less. And the safeguards are that Ofwat needs to check the project, but they also need to ensure water supply. So now they've got a conflict of interest. They have to guarantee water supply, and yet they need to sign these projects off or resist them if they think it's not needed. So how do they handle that conflict? The government needs to make sure that the overall cost doesn't land on the books and spook the boating population. And Thames Water needs some way out of their 20 billion worth of debt, and the government doesn't want to be landed with that. So this doesn't add up well against those that are trying to say this project doesn't make sense, because for reasons outside of that, it does make sense to others. So there you have it. SESRO and RAPID, hopefully explain a little bit more. Effectively, it's a financial model or framework that allows for private investment in significant infrastructure. Ultimately, it will cost more for customers. It will mean that there'll be focus on delivering profit and not delivering on quality. We've seen it already, haven't we? I mean, let's take a look at Thames Water now. 20 billion in debt because it's paid its shareholders over the years as dividends. And where's the infrastructure? Where's the quality of water? Why are we dumping sewage into the rivers and into the sea? Why have we got water that's leaking out, which can take 75 years at the rate that they're fixing it right now to actually achieve the goal of 90-something odd percent leak reduction? It's ludicrous. One of the things that I'll finish with is that I think a lot more people have started to wake up to the fact that this is going to impact them, especially with things like the land grab, which is being repurposed for the build out, for example. So it won't even be used once the reservoirs in place is just going to be grabbed for the purpose of either environmental and habitat or for the purpose of building. So it's going to have a big impact. It's going to impact a lot of people in the local area, and it's also going to cost 15 million people somewhere between £8,000 and £10,000 over the course of the lifetime of the project. It's a significant impact, and I think people need to just be aware of that before we sleepwalk into it. If you've liked this video, then please like it and subscribe, because as I publish more videos, you'll be notified about those, and it sort of helps build up the following with regards to this project that's ongoing and will go on for many years. As always, thanks for watching.